So as a recap, the two essential parts of a mortgage loan, you basically have the obligation, which is detailed in the promissory note, and then you have a pledge of a property, which is secured by either a mortgage loan or a deed of trust. Now, I have this last bullet point here because I want to remind you that when we talked about this early on, that the real estate can be thought of as a bundle of rights, right? You could have the rights to the air above the property. You can have the rights to what the properties are, the cash flow the properties are generating, and you can have rights to the minerals in the ground. Any one of these rights or these interests can be mortgaged as long as it can be transferred to somebody. So we talk about fee simple, having fee simple ownership, which is basically that's all the rights in the bundle. But you can mortgage the life estates, you can mortgage leasehold interests, you can even mortgage options to purchase real estate. So as long as it can be transferred, you have the ability that asset, if you will, has the ability to be mortgaged. Now, I hope you're never in a situation where you own real estate or you have a loan and you have to go in default. But if you're on the lending side, you will have the occasional borrower who defaults on you. And there are generally three different types of default. Um, the first is what people typically think of as default. It's called a mortgage default. And it's basically a breach in the mortgage contract where somebody's not paying, they can't make their payments. So the borrower does not have the ability to make the payment. I'm going to jump down here to the third type of default. That's a strategic default. So a strategic default is where the borrower has the ability but does not have the willingness to make the payment. And sometimes you run into the situation where the borrower's view, the long-term view of the value of the asset, is less than what the mortgage payment is. So I'll give you an example. If you were to purchase a property at 100, so let's say that's the peak of the market, and you got a $70 loan on that. So you bought the property for 100, you came out of pocket for 30 of equity, and the bank provided you 70 of debt. All of a sudden you have a crisis and the value of that property drops to 50. So that value is less than what the debt amount is. Some people make the decision, hey, I can make these payments on a monthly basis, but why would I ever, over the life of the loan, pay 70 for something that's worth 50? That just doesn't make any sense. I had friends who, once we graduated from school, moved out to San Francisco and bought a house right before the great financial crisis, unfortunately, paid top dollar for their house out in San Francisco. And as soon as the crisis came along, the house was worth half of what they had bought it for. And the houses were also less than what the loan amount was. And they made the decision to strategically default. That sort of messed up their personal credit histories for a little while. They certainly lost their equity, but they made the decision on a long-term basis that it just didn't make any sense to pay 50 or to pay 70 for something that's only going to be worth 50. Oftentimes you will also notice that the large, more sophisticated borrowers, Blackstone, KKR, Brookfield, they will strategically default on their properties as well. And the argument that they make is that, hey, we have a fiduciary duty to all of the investors in our fund. And if our long-term view of this asset is it's only going to be worth 50, and we've put a loan on in the amount of 70, then it just doesn't make sense. We are breaching our fiduciary duty to our investors by paying 70 for something that's only going to be worth 50. So the last type of default is what's called a technical default, and if you'll remember that the promissory notes are large. There's a lot of information there. Oftentimes, I would require my borrowers to send me financial statements either on a quarterly or an annual basis. And I just wanted to make sure that the property was performing as we had expected or as we had budgeted, and the property was still or the collateral was still going to be able to make those principal and interest payments. But sometimes my borrowers didn't send me those financial statements. Now I have the legal right to go out and say, okay, listen, you defaulted, right? You are not upholding the agreement we had at the beginning of this loan. So you're defaulting, and I'm now going to foreclose on you. But that's sort of silly and it's sort of an extreme situation. So oftentimes when a borrower technically defaults, they don't get foreclosed upon. But what that allows the lender to do is to go back and to have a conversation with them and maybe bump their interest rates a little bit, maybe ask for escrows. They can start a conversation, say, hey, listen, I want to make sure that everything's okay at the property with my collateral. And that might result in maybe the borrower like paying a higher rate. Maybe a new escrow is created to provide some security for the lender. So those are the three different types of defaults. So if you default, one of the options that you can carry through with is foreclosure. Now, in a couple slides, I'll go through a couple different options that you have if you've got a default. Foreclosure is not the only option, but it's oftentimes used. So the type of foreclosure that you might go through is often dictated by whether it's a lien theory state or a title theory state. So sometimes you will have to go to the courts, and this is called a judicial foreclosure, to basically earn the right to be able to foreclose, to own the property, and then to sell it to fulfill your obligations. This oftentimes is very costly and lengthy, and lenders would prefer, although they oftentimes don't have a choice because of the states or the geographies that they're lending in, they would prefer to be in non-judicial foreclosure states. You can also go through a foreclosure suit. And this is basically where the lender obtains a degree of foreclosure and sale. Now, you might also mention that the borrower has what's called an equitable right of redemption, which basically means that until that title is sold on to the absolute last second before that title is sold to the next owner, the original borrower can come and claim that title back if they can pay all their late payments, all their late fees, and cover court costs. This process is called redemption. So again, you can be in a judicial state, which means you have to go through the courts, but you can also be in the lien theory state, where you have a power of sale. This is also called a non-judicial foreclosure, and it's where the mortgage or trustee conducts the sale of the property. It's much quicker and much less costly than having to go through a judicial foreclosure. The power of sale is advantageous to the lender for a couple different reasons. First, it's faster, it's cheaper, and oftentimes, depending upon the state, the borrower doesn't have a statutory right of redemption. And again, this just happens to shorten up the process even more. The process of foreclosure, no matter whether it's judicial in a judicial state or in a non-judicial state, is pretty costly. Additionally, banks' core competencies are not as real estate actors or real estate market participants. They are risk managers. They attract deposits, and then they are good about lending those deposits, assessing risk, and lending those deposits out in the form of loans. They are not good property managers, and they know that. So oftentimes that discourages them, particularly in a stress environment. If they're like, "Oh my gosh, we're foreclosing on more loans than we're making," this is getting ridiculous because just because of the stress period, we might want to think about not foreclosing or finding a different alternative than becoming the owner of these properties through the foreclosure process. The groups in the bank that go through work with customers or lender or borrowers that have defaulted, or that they own, that they've gone through the foreclosure process, now they own the properties, are called the workout groups. Um, These groups at banks are great places to learn real estate because you will see extreme situations where the borrowers fight you tooth and nail and you've got to go to court, and you learn a lot about the process and how to run or how to operate a commercial real estate property. There's also another option called a short sale, and that's typically, oftentimes people will think either it's short or long from an options perspective, but this is a little bit different. A short sale, from a real estate perspective, is when the lender sells the loan at a loss. So if I'm a lender and I have a loan of 70, instead of going through the foreclosure process, I have an option just to sell the loan. But the market, whoever I'm selling these loans to or this loan to, might know, well, I know you're having problems with it, and I'm going to have to take on the problems. So I'm not going to buy it for 70. I'll buy it for 50. And so if that's the case, that's a short sale. Now, it probably goes without saying, and I hope you're never in this situation, but that federal bankruptcy law trumps state bankruptcy law. In this, when there's disputes about which federal or state should regulate the process, again, that just causes costly delays for